All right. Good evening, everybody. Good evening. Happy Tuesday. Welcome out. Sorry, I got some in my tooth. Okay. Okay. We're going to give it a minute or two. Small group. Yeah. Where's everybody? Everyone should want tonight. I was like prepping it, talking about calendar spreads. This could be the strategy of the summer right here. I would expect to be doing some of these via the alerts uh, for sure. Great complementary trade to directional trading. So let's give it a minute. We'll see if others come in. You know what I'm gonna do? Trying out the alert. Love it. Let's hope we get that bullish kick that ignites that alert, right? That's what we're looking for. Um so very nice. Let me just real quickly post this link. I'm gonna copy the link. I'm gonna go to Discord. Sometimes we have people sitting in there, and I'm just gonna put it in case they want to join us. Join us now for calendar spreads. 3 exclamation points, I would say, is in order. Of course. There it is. All right, we'll see if anyone else shows up. How's everyone doing? You guys doing all right tonight? It's good to see you. Market's a little bit iffy right now. We're sensing it. Market posture dialed back, but we're still a 6. I'm still looking for the bounce until it proves otherwise. Right? Until it proves otherwise. Now, do we have some concern developing on the VIX? Yes. So here's what happens. If the market gets strength and goes up, VIX drops, might reset that signal. Our trade should trigger. We should have other trades that are working. I would imagine you're in some trades that you're holding on to right now. And boom, it works. However, if the hedge signal comes, you're likely to not get the trigger on a new trade, any new trades. So you'll be managing existing trades, possibly putting a hedge on, and then reevaluating from there. Seems like a reasonable plan to me. Had an excellent training session tonight. Oh, good. Remind me, is it Brian that you're working with? Brian Latta? Yeah, great dude, great trader. I actually had a conversation with him not long ago. It was just Friday morning, actually. We had a coaches get together, and he said it was snowing in Sonoma, California. Imagine. Anyways, okay, let's dive in. Welcome to the Market Watch Group Options Foundations 2.0 calendar spreads application day. If you missed day 1, you're going to want to go back because there's some things that'll help connect some dots for sure. I'm going to do a quick recap, then we're going to dive into the platform, and we're going to play with them. Is the VIX low like 12? At a 12-13, a calendar spread is a no-brainer. If you're like, would it be reasonable to do a calendar spread If the VIX was 12 or 13 before you even finished your question, I'd been like, yeah, it is. Well, 12 or 13. At 15, we have to be a little more careful, a little bit more careful. We can survive it, and I'll tell you why, but we certainly have to understand that. Let's dive in. Quick disclaimers, as always, education illustrative only. We're not brokers. We're not advisors. We don't give guidance. We don't give recommendations, yada, yada, yada. The long form is here and in your email. Today's agenda, what are time spreads? We're going to talk about calendar spreads, specifically time spreads, horizontal spreads, calendar spreads. It's used interchangeably. We'll talk about determining strike prices. How do you decide? And it's, you know, the long and the short strike are the same. We'll remind you of that here in a second. So you're deciding where do you put the whole thing? At where we are now, a little above, a little below, and we'll talk about what the implications of that are. And I'll actually show you on the platform. Okay, sorry. Give me just a second here. Okay. It's killing me. Okay, let's dive in. What are time spreads? Definition, time spreads, also known as horizontal spreads or calendar spreads. What are you doing? You're purchasing and selling. With spreads, that's what we're doing. We're buying some, we're selling some. And what are we trying to do? We're trying to find some balance and then skew those Greeks. We still have a full Greek session coming our way later this month. But I've been given plenty of preview, I think, into Delta and Theta and Vega, right? We're trying to skew the Greeks. A time spread makes its most amount of money from time, Theta. You'll sometimes hear people say this is a delta neutral strategy. Well, it can be, and I'll show you what I mean, but we'll talk about what does delta neutral mean. Well, it means you don't want it to go up or down. You want it to stay right where it is. If it's delta positive, you want it to go up. You're bullish. If it's delta negative, you want it to go down. You're bearish. Delta neutral, what do you want it to do? Stay where it is. That's fine. Now, of course, we know it's not going to just stay right where it is. It's going to go up or down. These are not rigid trades. I can and should and will be ready to adjust this trade by adding another one to it. Possibly even a third trade. That's how I trade these. There are some people, and I would recommend you Google it or Chat GPT it or Gemini. I've been playing with. Are any of you onto the? Are you into the AI yet? If not, you should be. My two favorites are Chat GPT, which is OpenAI, and they're half owned basically by Microsoft. And then there's Gemini, which is Google. Gemini's made some strides, and of course it will because it's Google. Google has a lot of money. So if you're not utilizing it, here's the thing about it. Let me tell you how I would look at it in the beginning. It's like a better search engine. So you could, like, if you're like, I want to learn about credit spreads, you go to Google, you type credit spreads. Well, no. Say, I want to learn about calendar spreads. And you go to Google and you Google calendar spreads. And what are you going to get? You're going to get a bunch of ads, a bunch of people trying to sell you their service, right? And you're going to get suspect information. But if you go to ChatGPT and you ask the same question, you're going to get a succinct answer. You could ask it to give you some reference sites to look into. It's really cool stuff. So if you haven't, it is an amazing trading aid. It'll help you write trading rules. It'll help you define things in your trading plan. It's a better writer than we are. I can tell you that. So anyways, it's quiet. No one else is answering. Talk to me out there. What are time spreads? We are doing the same strike price, but different expirations. The way we're doing these, they're considered long. We're buying it. It's a debit. I'm going to sell the short-term option 2 weeks out, 2 to 3 weeks out. I'm going to buy the long-term option 3 to 4 weeks out. Hi, Sandy. Good to see you. I saw your message. I'm just rooting every time that I get to see you. Hope all is well. Okay. So we'll play with these in just a minute here, but I'm not looking to put this on for a long period of time. I'll talk to you specifically what I'm looking for and why I'm looking for it the way that I am. Other people trade these differently. If you say, hey, what are three different ways I could trade calendars? You could find three different ways. I'll show you how I like to use them because I think that they work so well in a bullish. Now we're in a bullish market, and you've noticed with implied volatility low, it's hard to get time working on your side. You're always buying time, and if you're always buying time, your theta negative starts to compound and stack up, and you're like, wait, all of a sudden you look at your portfolio and you're losing 70, 80, $90 a day in time. $90 a day. Surely I could do something about that. Yes, and don't call me Shirley. Yeah, a terrible joke. I know. I'm just trying to get you guys to say hi and talk, and I feel like I'm monologuing today. And I know these are more teaching, but I still want to feel like we're dialoguing. So, what's the purpose? Time decay, number one. Turn on the mic. Time decay, number one. Volatility, number two. Those are our priorities. First, time. Oh, Sandy, you cannot only weigh in to bash me. Sorry. Nope. You gotta. Now you owe me a compliment at some point today. You don't. It doesn't need to be now. In fact, wait for it so it doesn't feel terrible, so it doesn't feel forced. All right. Time decay is our top priority. Volatility is our second priority. Time decay is our, let's be careful, consideration, right? So when you think about a bull call spread, you'd be like, oh, my top priority is the direction. And my second priority is time. My last priority is volatility. You can see that the order is so different than it is here. And that's why every trade has where you're thinking, what am I thinking about here? What am I focusing on here? And it's not always that you're just like, I'm so sure the market's going sideways. You'll find as you get more comfortable with the Greeks that you're balancing it based on the Greeks, right? You're bullish. What do you want? I want a positive delta. I would love to always have at least, if I'm theta negative, very small. I'd rather be theta positive if possible. So how can I get positive theta while I'm buying options? I'm buying options. That's negative theta. So these are strategies that allow me to put these trades on. They're neutral on delta, they're positive on theta, and they're positive on vega. And then I might buy options. And if I buy calls, they're positive on delta, negative on theta. Right? So now I'm net positive on delta, I'm net neutral on theta, and I'm net positive on vega. Volatility is low. That makes a lot of sense. That's how we want to be thinking about portfolios. Okay. So we're thinking neutral and bullish directional time spreads. So we can do time spreads where we anticipate very minimal movement. And we can also do a little bit of a directional time spread where you might actually put it above you to sort of almost call your shot out, right? You're sort of saying, hey, it's moving in the trend. So where do I want it to be? I'll show you how we can use our trend lines to help with that. Okay. Calendar spreads. Same strike, different expiration. Designed for stability, capitalizing on time decay with minimal dependence on price movement. Construction, choose the underlying asset. I told you what I like. I like ETFs, SPY, QQQ, IWM, DIA, maybe some of the XLs. Some people like to do them on individual stocks, which is fine. Yeah. What are we doing? We're staggering short and long term to exploit time decay. That's it. let's just dive in. We went through this. Implied volatility, we should be low. No, let's go through this. Determining strikes. First and foremost, implied volatility should be low. We're typically going to go at or out of the money. At or above the current price. Outlook should be bullish, neutral to bullish. Yeah, let's go see where it puts us. I don't like those slides. I need to make a note to come back, and I want better slides than that next time. Let's go to SPY. Okay, so let's bring up a chart. Let's just start with a chart of the SPY. And I'm going to go to 6 months. Now, how have I been determining where to put strikes? So the first thing I'll tell you is the ideal time to put these on. I'm going to dot this. Where's my drawing tools? Drawing tool, annotate. And where's my stamp? Okay, here we go. There. Even when we're down a little bit, what am I pointing at? Are you seeing the pattern? Okay, what am I looking at here? I'm looking at time. So now let's draw some vertical lines. When it's overbought, crossing back down, we're saying, hey, we think this thing's overbought. So what's it likely to do? Well, we're not bearish. We're not going to buy puts. What can I do instead? I can do calendars. So this is happening here and here. And so you'll notice what's going on. A lot of times we're at high points, right? These are high points for the most part. Now this one would have been a little more dangerous, but I'll tell you, you still would have been fine. So as I draw these, you're going to see the next step of this pattern is what happens next. How long do I need this to go sideways for? A week, 5 to 7 days, 5 to 7 days of sideways or adjustment, and we'll be fine, right? So with all of these, if you look what happens, where are we 5 to 7 days later? You can see it went down, right back up. And it didn't go down far enough that we would panic, right? You'll see that we have some room. These things can move a couple of %. We don't have to worry about it. And you can see what happened with this one. This one actually went down and then up to here. So this trade, we might have added a second one. So here there might be 2. And then what happens? It goes sideways, pulls back, and you're out. And you can see from these points, sometimes it goes sideways, sometimes it goes sideways to up. If it goes up, we put a second one on. Here we would have to put 2 on. And by the time it pulls back, time is expired, you're out. And the next one you're on, and then you're out. And then that's it. Time. Remember the old adage with trends. We walk upstairs and fall out windows. We don't expect markets to just crash higher. Like, oh, it's smashing higher. We expect what? 8%. That's the S&P on average in bullish years. It can get 20, it can get 30, but I'm saying over time on average, 8%. We're 8 to 12. That's it. So this is a strategy that as it just sort of, especially if the implied volatility is low, 2003, huge bull market coming out of the tech crash. Huge bull market. 2004, sideways. 2005, sideways. 2006, first half, sideways. I mean, literally 2.5 years, the market just Nothing. And I wish that I could tell you, oh my gosh, you guys, you should see how much money I made trading calendar spreads. Problem is, it was 2004. I mean, I'm, uh, 4 or 5 years into it. I didn't know this strategy then. Oh, what I would have done with it rather than languishing like everyone did. You're up a little, you're down a little, you're up a little, you're down a little, it's sideways. You own stock, it's not moving. You're trading, it's not moving. It's very frustrating. Covered calls did well. If you did covered calls, you can make some money in that market for sure. Premium's not much though. Right. So it's about, do we have the right tools in our toolbox for the right jobs? And this is a job where it's like, hey, I'm going to be now. Here's the interesting thing. I'm going to change colors because here I'm thinking about getting into bullish positions, right? And you can see that the market is moving higher from those times, right? Market's moving up, market's moving up. So can both of these strategies work simultaneously? Yeah, they really complement each other. Bullishly trading the market for bounces, neutrally trading the market for sideways and pullbacks with an ability to adjust. Is there going to be a time where you put it on and then it breaks out and you slap another one on and you're thinking all it has to do is pull back, and then it doesn't pull back? And then you're like, oh shit. Yep. And you take your loss. It's not that bad. Right? Maybe at or 1 to 1.5 times the size of an average gain. But it happens, 20% of the time. So it's a great strategy. Maybe not even that. I'll tell you what, sometimes you can really get, if you get 20-25% in a week, you take it off and you've already put another one on. This is a strategy that you just can be doing over and over. As long as the conditions are right, you're doing it over and over, and you can do it on different markets so that your timing of how and when you put these on are offset. And what you're doing is you're just sort of putting a blanket of time decay. Now, if the market makes a smashing move, then you'll ease up and you'll be like, whoa, right? So right now, if we were at a 7, we'd be like a little less inclined, but it's been working great. Calendar spreads. So let's go do them. Hopefully you get the gist for me of how they work. Now, what am I looking to do? I'm looking to sell one, buy one, sell 2 to 3 weeks, buy 3 to 4. I used to always go 2 weeks apart, but lately I've been finding that even just a 1 week spread, I can actually get in and out and I get more time on my side. So let's come in here to a calendar spread, and I'm going to go Friday. I'm going to go to the 26th, and then I'm actually going to look at the 26th and the 3rd. So I'm going to look at April 26th, and you can see it's not the 3rd of May. I'm going to have to manually change that. Okay, now the next thing we're doing, let's just put it right at the money. The SPY is at 519. So we're going to put it at 520, just right at, slightly out, right a little above. Okay, I'm going to use puts. Okay, so I am over here. And remember that we are debit, we are buying, so we are on the ask column. I'm looking at the 520. Why the 520 instead of the 519? You'll notice that whenever you look at the open interest at the big ones, those are always going to occur at the $5 increments, right? This one doesn't have it, but the other two do. So I'm just going to go ahead, and that's where I'm going to end up. I'm going to click on that 38 cents. And that brings this up. And it says that I'm going to sell 10 of the April 26s, buy 10 of the April 30s, but I don't want April 30. I want what? May 3rd. Possibly May 10. That's 2 weeks apart. This is 1 week apart. You can see what happens. Well, the debit's significantly lower. That's an advantage. You can't lose more than you put into a trade when you're on a debit, right? You cannot lose more than you put into the trade. So that's your max loss. let's go look at what we built. So let's analyze this trade. And we were looking at these already. I'm going to close that. I'm going to open this. And this is our risk profile for a calendar spread. Remember how this risk profile works. We have the purple line. We have the black line. And down here, it has a little bit of an assist as well. The purple line is 4.8. That's what? Today. Should be 4.9. Should actually be 4.10 because it's going to be tomorrow. Okay, so 4.9, there's tomorrow. Okay. The other one is 4.27, which is what? That's the expiration. I need this to be red. That's the expiration of this option down here that we're selling. So the interplay between these two helps us to visually see time decay, right? Time decay. Now, how so? So this area here are always important for us because that's the shift, right? Anything over here in the middle, and I'll show you this in a second, this is going to move up as time advances, which this is, remember the purple line is your profit line. So as long as it's between about 512 and 529, if it stays there, nothing. We don't have to worry about anything. It looks great. So you would profit at the 219. Where's the 219? 519. Yes. Yeah. In fact, you can see that like our sweet spot right there, that's at 520, which is our strike price. That corresponds directly with this. Okay. Now, where are we concerned? Well, we're concerned if it goes up too much or if it goes down too much. What do we want it to do? Remember what I said about delta. Delta neutral. What is our delta here? 5. That's pretty close to neutral. 5. Stay here. Now, if I want you to watch what happens as I drag this line. This is simulating if the stock were going up. If the stock goes up, you'll notice that the more the stock goes up, our delta goes negative. Why? Because we want it to go back to the middle. That's where we want it, in the middle. And if it starts to drop this way, what happens to our delta? It's positive. Why? Because we want it to go up back to the middle. That's delta neutral. We want it right in the middle. If it goes one way, we want it to come back. Now, we're not really going to panic about that, right? Because we know it's going to fluctuate up or down. We don't worry until it does what? Well, until it breaks 528 or breaks below 513. As long as that doesn't happen, what do? I watch time tick. Boom. Now, what happens? Watch that purple line as I move this date. Boop, there's another bit. Boop, there's another bit. 413. What day is that? That's Saturday. You can't even trade today. So I get a freebie. There's the 14th. Can't trade today. I get a freebie. Now what? By the time we come back, if it sits right where we are by Monday, this trade's making $200. Well, if it moves up or down, what? Nothing. I just wait. I don't have to do anything. Now, if it does go too far, let's say it gets out here to 527 and you start to get antsy. What do I have the ability to do? I can put another one of these on over here. Now, how long can I do that for? I got in this trade. When I click on my date, can you guys see my date right here? Or is this like, am I just moving my mouse and you can't see it? Or do you see my calendar? I've always wondered that. You see the calendar? Okay, good. So, we advance here till Monday. Now, remember, we have all the way until this Friday, the 26th. So this entire week here, I have the ability to adjust the trade. If it never goes higher than 527 or never goes lower than 514, there's no decision to make. I just sit on it and wait. And just wait for time to keep ticking. Tick, 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 tick. And there's times where all of a sudden you're like, oh my God, look where we are. Now remember, I said 20 to 25%. By this Monday, you only paid 99. So you're into this trade $1,000. You're at 200. You're sitting close to 20%, just like that, 1 week. Bang. Right? But I can do better. Now here's what happens is this week here, I might be thinking to myself, I'm going to manage the trade that I'm on. Then what? Well, then I might come here and sell this. You have to be careful. You have to be careful because this has to be different. You can see it wouldn't let me have identical components. But you can start to leapfrog these. One of the reasons I would put them apart is because it makes it easier not to get confused putting more trades on. I found one time that I closed when I put a new trade on, I closed a piece of the other. So that's what you can avoid by going from, well, let's take a break. Let me go back. Let me get rid of a couple of things. Okay. The 2-week, 4-week debate. So right here, you'll notice I have a 7 delta. I'm going to write them. Nope, I'm just going to draw. We have a 7. I need this a little thicker. Never mind. 42 and 90. Actually, these are going to be a little off, but that's because of the date, but that's okay. So let's take this and go to May 10. Now we're going 2 weeks apart. What happens? The cost goes up $1.60. Actually, in this case, I think I like this better. So what happened? My delta did double, but it's still very small. My theta went from 40 to 70, I believe. Is that right? 40 to 70? 42 to 70. So I got about 70%, 75% more delta, but I only had to pay 60%. Well, yeah, I'd be okay with this. I like this. I'd probably do less contracts because it would carry a little bit more risk. Now, what that would allow me to do is then put on a trade in here. If I analyze this, now I have the ability to put on a May 3rd and a May 17. And these things can run simultaneously, leapfrogging each other as long as the conditions are right. This is not a directional strategy. Remember that. It's not directional. Now let's go back to if this first trade, what happens if it does go out here to 529? What am I going to do? Well, I'm going to come out and I'm going to put on, I don't even have to go right at 530. I could probably come out here all the way to 535. Okay, now let's just see. May 10. Huh. Do we not have these? Singles. What am I looking for? 535s? Of course there's 535s, right? 535s are here. And made sense. Why is it not letting me turn it into a debit? Yeah, I don't know what's going on with this one because it's kind of skyrocketing. Let me see if it lets me. All right. Well, so that if you notice what I'm looking for, do you see how this has like one on top of the other? It has kind of a funky look. That's not right. It needs to look like this with one triangle, the other in a swoop. So when I have both of these together, what does it look like? Right. So this is the one we started with. We're assuming that the market gets out here to 527. And at 527, we decide we're going to put this trade on. Okay, now let me uncheck this. And all the expert there should be two, and they both will have the same different expirations. So both of these are calendar spreads working together, which means they're both May 10, April 26th. If the next week you started a new trade, those would be different expirations. Let's just say we paid the same amount for this. $1.61. Put them both on side by side, and now what? Now it's at 527, and all we need is 5 more days, and you'll see that it goes from where are we now? Let's say we're at 527. You're at $300. Then what? 2 days later, 530. 5 days later, you're at $1,000, and you have this range, right? So this is not a directional like I have to get in and then out right away. It's I can put it on, I can let it sit, I can let it sit. If it needs a new one, I slap a new one on, let it sit, look for the pullback. It's about always a reversion to the mean, right? So what's the worst thing that could happen here? It goes up for 12 days in a row. That's going to be painful. And there's been times where I've put 3 of these on. I put it on, and then it went up, and it got all the way up, and then I'm like, okay, I put another one on, and I'm like, now all I have to do is pull back. And then what did it do? It went up. And I'm like, do I eat it? Do I put another one on? And I looked at it. There's been times where I'm like, I can't put another one on. It just no matter what, it wouldn't work out. So I just took the loss. Or put a third one on. And then if it pulls back, now I have had times where it does pull back on 3. Magnificent. All of them make money. Boom. Huge trade. But there's also been times where I have to take that loss, that third loss, and that's painful, but not that painful. Not it right? When the probabilities are 80, 85% of success, even if your loss is bigger than your wins, which it's not, I can live with that. That's the system. So what do I like about this? This is a system that can be, it's non-correlated to your directional system. You can work this mutually exclusive and independent of what you're doing with your directional trades. They don't interfere with each other. They intersect sometimes. A lot of times when your directional trades are like, you're like, oh my God, nothing's moving. Your calendar spreads are just popping profits. Boom, boom, boom. And you're like, great. And then your directional trades take off, and you have to adjust these. And every now and again, you take a loss. And as you take that loss, what do we say has to happen? The market goes up 12 days in a row. I tell you this, if that market goes up 12 days in a row, you damn well better have some good bullish trades on where you're making a bunch of money from your directional trades. This is what I mean when I say these two play well together. Directional is doing well. We're adapting and adjusting calendar splits. Directional trades take a break. calendar spreads start cashing in profits. When we hit a market that is a sideways market, this thing can grind. I've had markets where 14 weeks in a row, calendar spread, 20%, 42%, 28%, 70%, 20%. I mean, it's just like boom, 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 boom. Loving it. This is how you diversify by strategy, right? So that if the market's not doing anything, you're fighting to find momentum. What do? Well, you have this. You have this working for you, right? Now, what if the market drops? If the market ever dropped, here's the good thing, okay? So let's take this one off. This is if things went right. Let's go back. I'm going to restart. Okay. Ask questions as if the stock goes up to 524, then drops back to 519 just for expiration. Yeah. And you can set, I mean, I'll get out early for sure, right? Like if it was, this thing doesn't expire until the, what do we say? 26th. And this is the 20th. So I wouldn't get out until, but if I got to the 22nd, and it's right here, and it's like, yeah, what you can actually do, you can set orders. So let's say that the market on this day was just almost perfect. It's right here at 521. You'll notice that you're making $1,000 all the way to like 524. At 524, it drops to like 900. So if you let it go over to here, you're only risking like $100, right? So let's put this at 524. So you can see you're risking about $1,000 of profit. Now, if we do that on the other side, you can see something like that. That's the range where you're making at least $900. Why would I do that and give it one more day? Because watch this here in the middle. Yeah. If I give it one more day, boom, I'm at 1,200. I'm at 1,200, and now those outer edges are actually making more than I was making in the middle. I'm only making 1,033. A day later, I'm making 1,047 and 1,076 on the outer edges. So what do? Now it's Tuesday the 23rd. What do? Give it another day. How do I do that? I can put an order in that says if SPY goes at or above 524, close my spread. That market. This is SPY, highly liquid. I'll get out pretty quick. And I can have an order down here that says if it goes below 517, get me out. So now if I just leave it. And then all of a sudden, let's say, what day is today? Today's the 23rd. Remember, we have 3 more days. So let's say the next day, boom, we the 24th. Well, now we're making 1,400 in the middle, 1,200 on the outer edge. So if it crosses that line, we expect to make 1,200 or a little less. Crosses this line, 1,250, a little less. And if it's still in the middle, what do? You know what we do. We give it one more day, right? We give it one more day, because if at any time it crosses those lines, it closes itself. If it doesn't, we get one more day. Boom. Now what? Now we're at 1,700 in the middle. Now we're at 1,400 on the edges. It's now the 25th. It's Thursday. It's still here. Now, is it likely that that's going to happen? No, I don't think so. Set it up so that if and when it breaks. Now, here's the thing too, is every day you could actually give it a little bit more room too. Right? So if we go back here to the 22nd and we say, you know what? I'm going to give it one more day. I'm going to go to the 25th, and I'm going to go to the 525, and then down here to 516. And you're like, oh, but you're risking more, except you're not, because now 2 days later, you're at $1,100. And then from here, you might say, let's give it just another $1 on either side. And you give it one more day. And now you're at this. And now I'd say, that's it. I'm done here. You can work these, with very minimal amount of effort. You can do it at night, right? When the market's closed, you can put automated orders around it so that, and if you had 2 trades on, you could do the same thing. Whereas if it just sits in between, if you had 2 of these on, right? Remember, if you have 2 of these, then you're going to have one order way down here and one order way up here. And as long as it stays in the middle, nothing. You just sit on it. Time's passing. This is not a like, oh, we sit and stare at it type of a trade. That's what makes it great. It's very different than what we're used to. Now, last thing here. What if it were to, let's go back to today. We're starting from the beginning. Okay. Here we are right at the beginning. All that looked magical, but that's 2 weeks from now. What about now? What if this thing dropped? What if we dropped all the way down here to 510? We're like, oh, I'm gonna be losing 350 down there. What do we say? 510. Let's put it in. 510. I'm down 350. That's the market dropping about 10 points. Okay, so let's go look at that. So the market dropped about 10 points from here to here. So if the market dropped 10 points, what would the VIX do? Well, it went from, we'll call it 13.5, and it went up here to 16. We'll call it 2.5 points. 2.5 points implied volatility increase when the market dropped, right? Okay. So now what? We better, if we're going to look at this, we need to assess implied volatility. So I'm going to pop this little guy open here. This little cog is going to give me this vol adjustment. Now, this is where, as you look at our Greeks, what are we? We're delta neutral. We're theta positive. I'm going to put plus or minus. That's neutral. And then you look at our Vega. What are we? 2 pluses. Look how big that is. 150. So if the volatility goes up, it's going to pump value into this. If the volatility goes down, we're going to maybe be in trouble. So we have to worry about if the volatility drops out here. That's something we'd have to be a little bit aware of. Is how would we contend with that? Now, we said that if the market drops, the volatility is going to rise. So let's put 1% in. At 1%, our loss has gone from 350 down to 380. That's nothing but implied volatility pumping in our favor. Let's go another 1%. We're break even. If we got 2.5%, we would actually be making a little bit of money down here. Which means what? Well, I could let it go all the way down here to 508. If it goes down here to 508 now, and I'm sitting like this at around 2, that's perfect. But the problem is if it goes back up, that vol comes back down. So what can I do here? We haven't talked about it yet, but I could actually put a butterfly spread combined with a calendar spread, and it creates a whole spectrum of time decay. So that's why I love these types of trades, because they're adaptive, they're flexible. I can adjust them. It's not, a lot of times when people try to adjust options, it's out of desperation. The trade's gone wrong and they're like, oh, I want to try to adjust it so it can go right again. That's not what's happening here. You're basically saying, hey, I recognize that in the fluctuations of the market, it can go 2 to 3%. And then I can make an adjustment to the trade and let it do what it's supposed to do. But look at this. This is not a fast, or this is steady. We're looking for time to work in our favor. That's a calendar spread. Now, these will 100% be a part of the alerts. If a calendar comes as part of an alert and it needs to be adjusted, there will be an alert for the adjustment. Sounds like you're in advanced algebra, right? The trades and the adjustments are not going to make much sense if somebody doesn't watch these videos to understand, like, wow, what are we doing with these trades? What are we trying to do? Now, you'll see some people who will do things like they'll buy 3 months and sell 1 month. And they'll just wait and wait. And what they'll do is they'll roll. And a roll means you'll buy back one and sell another. And they'll try to roll for credits. The problem is I'm not 3 months. That's not my posture. That's not, I'm right. I'm 5 to 7 days, 7 to 11 days. That's my comfort zone. So I needed a calendar spread strategy that matches a swing trade type mindset. If you're a longer term trader, you might like that 1 month, 3 month, and you might say, you know what, I'm going to go find somebody who provides more specific guidance. I highly recommend you do that. But for this group, we're following more of a swing model. And therefore, this is what we're going to be looking at is a, anywhere from 5 to 11 day mindset. Put it on week 1, adjust it week 2, start thinking about closing at the end of week 2, early week 3. That's it. And in week 2, while I'm looking at adjusting this one, if the market's moved up a little bit, but not enough to have adjusted, can I start a new trade? Yeah, absolutely. Yeah, I'll put another one on, put the same type of a system in place with those. So, I love these. This is options as inventory. You're not a speculator like I have to be right. The direction's up and down and up and down. This is I'm putting on inventory. I'm taking mathematical advantages created by low volatility and the subsequent positive time decay to put these types of trades on, to recognize that a low volatility market's going to move a little bit, typically a little more slower, right? Markets don't often crash up. If they do crash up, we hope to God that we have a posture that has us benefiting from that. We take whatever loss we have to with a calendar spread, then we get back to business with calendar spread because they'll work again. Picked up several tidbits for trading plan other than calendar spreads. Oh, love it. I love it. I really like these. I wish we'll probably come back to them maybe in May as one of our extra days. I'm still kind of planning the May schedule for the Tuesday, Thursdays. We're going to, rather than just jump right back into trading foundations, I'm like, well, let's have some fun. Let's do some experiments and let's hit on a few things that'll broaden our perspectives. So Thursday, diagonal spreads. Thursday is diagonal spreads. So yes, it's a hybrid approach. So it's kind of a combo of a vertical plus a calendar equals a diagonal. If it stays close, it behaves more like a calendar. If it moves aggressively to the upside, then it starts behaving more like a vertical spread. So they're very cool. And they work well in a low implied volatility market, which is a bullish market like the one that we have now. So they're very relevant because it's like, hey, if you thought it was going to be bullish and then it wasn't, wouldn't it be great if you could still make money? Where it's like, oh, I thought it was going to go up 10. It only went up 2. And yet here I am still making money. Probability. That's what we're putting in our favor with these trades. Probability, because time's on our side, because we don't need the stock to do as much because of the way that we structure the trade. Awesome. I have no doubt you felt like you were drinking from a fire hose tonight. My mouth kept getting dry. I feel like I was spitting out like a fire hose tonight. Anyways, we'll be back tomorrow morning for our midweek check-in. I don't expect markets to be flat because we're going to have CPI data and I think we're going to see some reaction. Who knows? Who knows? I'll see you guys tomorrow morning, 9:15 a.m. Thank you, Sandy. I know it's probably a little more difficult right now to make it, so I'm glad you did. Much appreciated. Thank you, everybody, for your attendance, for hanging out. You know I want more interaction. There's got to be questions. This is hard stuff. Either I'm really good at teaching it, maybe I'm okay. I've been doing it a while, but I've got to think, man. You got to have questions, so make sure you ask them. Thank you, Judy. It's good to see you. Have a great rest of your night, everybody. As always, happy trading.